rules. Money rules. Money. Welcome to the Money Rules podcast, where we tackle your personal financial matters with leading financial advisors. Your host, Boitumelo Ntsoko.
In today's rapidly evolving investment landscape, diversification and risk management are more crucial than ever. While equities often steal the spotlight, bonds play a pivotal role in achieving these objectives. Sean Kelly, a wealth manager at Parity Wealth Managers, joins us on this episode to demystify the mechanics and importance of global bonds. Before we start though, please don't forget to follow us on Spotify and Apple Podcasts, share this podcast with your friends, and download our episodes for easy listening on the go. Your support will help us grow. Welcome, Sean.
Afternoon, Timmy. Fantastic to be on.
What exactly are bonds and why are they so pivotal in the financial market?
Bonds are debt instruments that really serve as the cornerstone of financial markets. And when you purchase a bond, you're essentially extending a loan to the issuer, which is typically a government, a corporation, or some type of a local authority. And of course, in return for extending that loan, you are entitled to periodic interest payments, which are known as coupon payments. And you obviously get those payments regularly along with the repayment of the principal amount that you initially invested or bought the bond for. And I think, as mentioned, they are the cornerstone of financial markets because they provide a lot of liquidity for the issuer. So if you think of governments, they actually need to issue bonds to raise capital for things such as expansion, employment growth, etc. And it's a similar story with corporations. When they issue bonds, they're essentially saying they need to raise capital for liquidity needs. And it's a different type of liquidity instrument than in an equity market where you're essentially giving shares away. Bond market is essentially a debt instrument. And companies, organizations, and countries use this capital raising for specific projects or growth projects. Of course, it has ripple effect. So in government situations, an increase in capital does help with local currencies, which does affect good economic growth and general expansion, such as GDP.
So how do these bonds compare to the more commonly discussed equity market?
So the bond market is actually a lot bigger than the equity market. As of 2022, the global bond market was valued at around $133 trillion versus the global equity market, which is valued around $98 trillion. So the bond market is roughly 36% larger than the equity market. And, I think just to give it a bit of context, comparison to the general equity market, if you look at South Africa, historically, South Africa has had a relatively high interest rate because it is an emerging market. And that is seen as a higher risk, jurisdiction. Therefore, interest rates and that risk must be priced into that interest rate. So the South African ORBI, which is the All Bond Market, has averaged around 8.15% per annum return over the last 10 years and around 7.18% over the past 5 years. And this is important because when we compare this to a more risky market, such as the general JSE, we note that the JSE has only averaged around 5.6% over the past 10 years and around 4.4% over the past 5 years. So bonds, which are typically lower risk, have actually managed to outperform the general equity market, being the JSE, by around 3.5% over the past 10 years. And of course, investors are rightly asking themselves, why should they be taking on that extra risk for the equity market for less return?
You mentioned coupon payments earlier. Could you give us a closer look at how these work?
Yes, of course. So coupon payments are essentially the interest received, the interest that a bondholder will receive for holding that bond until it matures, or whilst the investor holds that instrument prior to selling. And these payments occur at regular intervals. Usually they're semi-annually or annually or biannually. And understanding the frequency of those payments is obviously important because it can help you predict the income you'll derive from your bond investment. So to throw a bit of numbers at it, let's, for example, say that you invest $10,000 into a 10-year bond with an annual coupon rate of 3%. Essentially, what that means is that you will receive $300 annually for the next 10 years, accumulating, plus at the end of the 10th year, when that bond does mature, you'll get your $10,000 back as a return of repayment of capital. So the coupon payment is essentially the 3% interest that you would earn whilst you hold the bond during the period.
And Sean, what are some of the key factors that influence bond prices?
So there's a lot of moving parts and interconnected relationships between the general market and the bond prices. But to touch on a few, I think the primary one would be like interest rates. Of course, there's an inverse relationship with bond prices and interest rates. So as interest rates increase, the bond price will decrease and vice versa. And this typically will occur because existing bonds with lower interest rates become less attractive compared to new bonds issued at higher rates. The second sort of key factor that does affect bonds is credit quality or credit ratings. So bonds issued by entities with higher credit ratings like AAA are perceived to be lower risk, and therefore, because they offer lower risk, they offer lower yields or lower returns. Conversely, bonds with higher risk, like South Africa, junk status and junk bonds, they carry higher returns because investors have to be compensated for the increased risk. Inflation is another big factor that affects bonds. Of course, inflation erodes the purchasing power of future interest rate payments and the principal. So the higher the inflation rate, the less attractive bonds look. Typically, it leads to higher interest rates. And as mentioned, higher interest rates have the inverse relationship to decrease the bond's price. And then another factor is maturity. So bonds with longer maturity are more sensitive to increases in interest rate and inflation compared to shorter term bonds. And of course, this is due to the fact that longer duration bonds will have a bigger effect on interest rate changes. So if you think about an inflation rate of 5%, when you get that coupon payment in 4 years, that 5% will affect your future value versus an inflation rate of 2%, which it wouldn't affect your future payment as much. So those are the sort of the main factors that affect the bond market.
Sean, you actually answered my next question there. So what are some of the considerations before investing in bonds?
So there's quite a few considerations. But I think firstly to note is that unlike equities that have the potential to compound returns and capital employed, fixed income and bonds in general, fundamentally are based on simple interest. So this means that the interest payments will typically always be the same with a bond, and the investor's capital is returned to them at the end of the period. It's not compounded. Secondly, and it's quite important to note, is taxation. So because you're receiving an interest income, this is included in your gross income. Specifically for South Africans, of course, you do get, specific tax deductions of around 23,800 Rand a year if you are below 65, or 34,500 if you're above 65. But any interest received will be included in your gross income. And of course, then you'll be taxed on your marginal rate. And then thirdly, which we've touched on a few times, is that inflation does erode future payments and capital payments. So it's something to consider specifically now that we are in a high inflationary environment. Typically, South Africa has had an inflation rate of, call it 5.2 to 5.5% over the last 10 years. But, more recently in 2022, we saw that increase to around 7%. So inflation does have an effect on the bonds. And you have to keep an eye out on and consider those sort of factors before, deploying money into a bond.
What role can global bonds play in an investment portfolio, and what would be the ideal allocation to this asset class?
It's an excellent question. It's a difficult one to answer. I think, global bonds certainly have a place in global portfolios. It does provide diversification for investors in terms of a different asset class, because they're seen as more stable and more predictable from an income perspective. certainly it's something to consider as your overall investment allocation. You are now in this high interest rate environment able to get around 4-5% in a USD US dollar denominated bond. And that's relatively quite high considering the last couple of years, the interest rates have been, 0%. So for us, we do view the bonds as a good asset class to hold at the moment. In terms of what the ideal allocation is, that's very specific to how your investment portfolio looks and what you're trying to achieve. Typically for a long-term investor, you'd want to have more exposure to higher risk assets that can grow indefinitely or will grow a lot higher than a fixed interest rate payment. But having said that, as mentioned, it is very important to have diversification within your overall context of your portfolio.
So for investors who are wanting to invest in these bonds, how do they go about this? And what are some of the key considerations before investing here?
So there's a few ways to get access to bonds. I mean, you can basically access them through income funds. If you look, there's a huge amount of income funds in South Africa. And these are probably the most popular sought after funds because South Africa has such high interest rates. Income funds provide a very good way to get exposure to SA bonds. And you can, of course, access income funds, directly through a unit trust, through easy equity platform, through a tax-free savings. And in addition to that, if you wanted to bring in global bonds, it's a very similar story where there are global income funds that give you access to bonds. You can, of course, buy direct bonds and hold them directly in share portfolios, but that is a bit more tedious and it's obviously more, it's less diversified. What you'll find is if you want access to bonds, you'll typically want access to a wide range of maturities, a wide range of different types of issuers to diversify your risk. And again, just from key considerations before investing, it is looking at what your income needs are, how long you're looking to invest, your risk profile, etc. So it is not one shoe fits all. It's certainly dependent from investor to investor.
So how do local bonds compare to offshore bonds?
So as mentioned, South Africa has typically had higher interest rates. And this is just due to the fact that South Africa comparatively higher interest rates to first world economies or global bonds. South Africa has managed to give, an average around 8 to 9% return, where if you look at the sort of global bond index, if I look at the Morningstar index over the last sort of 10 years, it's averaged around 0.73% return in dollar terms. So South Africa has certainly fared better from an income perspective. But having noted that, of course, South Africa is higher risk. And over and above that, you must consider the rand / dollar depreciation. So although the offshore global bonds like the US, which has only done around 0.73% return over the last 10 years or so on average, if you look at the exchange rate from the rand to the dollar over that same 10-year period, you'll note that the rand was trading around 10 rand 40 to the dollar 10 years ago. It's currently around 18.33. So that difference in dollar to rand over that 10-year period is around 76% depreciation of the rand or 76% appreciation of the dollar, whichever way you want to look at it. So again, South African general global bond market has performed better, or local market has performed better, but you must consider that global bonds, albeit they haven't given you higher return or higher interest, being invested in dollars alone has benefited you as a South African investor due to the depreciation of the rand.
Sean, just finally, how should investors view bonds amid economic uncertainty?
So I think especially during economic uncertainty, it does require a strategic approach. You must look at it as a stability and income perspective. Bonds are considered safer investments over stocks, and therefore, and they also provide regular income through interest rate payments. But you must also view it as, liquidity and seeing it as a cash plus option, perhaps. So instead of sitting in cash, perhaps bring in some bonds that give you a bit of extra yield or a bit of interest in hard currency. Similarly, in South Africa, we should view it as an income component and a lower risk to decrease our risk in our portfolio. And one thing to note is, amongst this economic uncertainty, we have to keep a very close eye, I suppose, on the interest rate risk and understand that bond prices and interest rates have an inverse relationship. So if we expect the interest rate to come down, which is what we do, we would expect bond prices to increase. And that might be a good entry point currently to say, well, we expect interest rates to come down, so perhaps good time to enter into the bond market. It's also important to know different sectors and keep an eye on different sectors across various agencies who issue the bond. So government, municipal, corporate, etc. That will spread your risk as opposed to having risk to one specific issuer.
All right. Thank you so much for joining us on this episode, Sean.
Thank you very much.
That was Sean Kelly, who is a wealth manager at Parity Wealth Managers. If you enjoyed the show, please make sure to follow us for the latest episodes, share the podcast with your friends, and download our episodes.
Thanks for listening to this episode of the Money Rules Podcast. To listen to more, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Moneyweb, your trusted source for business and investment insights.